Hello, my name is Anisha Lindan Anak Muda. I am from class DAC2B and my matrix number is 20DAC25F1024.
Hello, my name is Kayan Chong Kayin. I am from class DAC2B and my matrix number is 20DAC25F1011.
My name is Mariani Banu Alamin. My matrix number is 20DAC25F1003 and I am from class DAC2B.
My name is Josephine Busa Andri. My matric numbers is 20DSC25F10C4. I am from class DSC2B.
Hi Miss, my name is Daphne Harbek Ilham Anna Herbert and my matrix number is 20DSC25F1072 and I'm from class DSC2B.
Good day everyone. Today we will present our topic based on MFRS 137, which is provision, contingent liabilities and contingent asset. This standard provides guidance on how company account for obligation and uncertainties in financial statement. It ensures that financial statements are reliable and present a true and a fair view. This topic focuses on three main areas, which are provision, contingent liabilities, and contingent asset. Next, we will explain what a provision is. A provision is a liabilities with uncertain timing and amount or both according to MFRS 137. A provision is considered liabilities because it includes three main characteristics. First, there is a past event that creates an obligation. Second, the entity has a present obligation that already exists. Third, there is a probable future outflow of economic resources, which means payment will be made. Even though there is uncertainties in timing or amount, the provision must still be recorded in the financial statement using estimations. Now, let's look at some examples of provision. The first example is litigation. This happens when a company is involved in a lawsuit. If it is likely that the company will lose the case, it must estimate the amount and compensation and record it as provision, even though the final decision is not yet confirmed. The second example is warranties. When a company sells product with a warranties, promises to repair or replace any defective item with a certain period. Even though the company does not know how many products will be faulty, it must estimate the expected repair cost and record it as a provision. Lastly, refund. In some businesses, customers are allowed to return goods and get their money back. The company must estimate how many returns will happen and prepare for the refund by recognizing a provision. For example, if a company sells 1,000 phones, it may estimate that 5% of them will have defects, so the company will record a provision for the expected repair or replacement cost.
Building on the previous explanation, I will now explain about contingent liability under MFRS 137. A contingent liability is a possible obligation that arises from past event, but its existence depends on uncertainty future events that are not fully within company's control. It can also be present obligation, but it is not recognized because of the outflow of resources is not probable or cannot be measured reliably. So, compared to a normal liability, a contingent liability involves a higher level of uncertainty. One common example is a lawsuit. If a company is being sued, the outcome is uncertain at the reporting date. The company will only need to pay compensation if it loses the case. If it's win, no payment is required. Another example is a loan guarantee. If a company guarantees a loan to another party, it will only need to pay if that party fails to repay the loan. If the loan is repaid as usual, no obligation arises. So, in both situations, the obligation depends on future events, which make them contingent liabilities. In terms of accounting treatment, contingent liability are not recognized in the statement of financial position, meaning no amount is recorded. This is because they do not meet the recognition criteria, as the obligation is uncertain, the outflow is not probable, or the amount cannot be measured reliably. However, they must be disclosed in the notes to the financial statement unless the possibility of payment is very low. The disclosure includes the nature of obligation, possible financial impact, and any uncertainties involved. This ensures that users are aware of potential risks without overstating liabilities. That's all from me. Thank you.
What is a contingent asset? A contingent asset is a possible asset that arises from a past event. However, it depends on uncertain future events, which mean the outcome is not fully within the company control. It also represents a possible economic benefit, or in simple terms, a possible future gain. Now, let's look at some examples. One common example is a legal claim or lawsuit, where the company may win compensation. Other examples include a tax refund from the government, an insurance claim under review, and also a possible grant or donation that has not yet been approved. All these situations show that the company may receive money, but it is not confirmed yet. Now, let's move to the recognition of contingent assets. Contingent assets are not recognized in a financial statement because the income is still uncertain. However, they are disclosed in the notes when the inflow of economic benefits is probable. They will only be recognized as an asset when the inflow becomes virtually certain. This helps ensure that financial statements are not overstated. Let's look at the differences between contingent asset and provision. A contingent asset represents a possible gain, while a provision represents an expected loss. Contingent assets are not recognized, but provisions are recognized in the account. In addition, contingent assets involve a future inflow, whereas provision relate to a present obligation. In conclusion, contingent assets are possible future gains that are uncertain, so they are only disclosed and not recorded until they become certain.
Hello everyone, in these slides I will explain the recognitions and measurements of provisions under FFRS 137. First, let's look at the example scenario. Indah Jaya SDN BHD sells electronic products with a 1-year warranty. Based on the past experience, the company estimates that 40,000 ringgit will be spent on repairs. Now, the question is, does the company have a present obligations, and can the provisions amount be estimated reliably? Under MFRS 137, a provision should be recognized when 3 conditions are met. First is present obligations. The company has a legal or constructive obligation because it's promised customer a warranty when selling the products. Second is probable future outflow. Based on past experience, some products usually require repairs or replacement. This means the company will likely spend money in the future. Third is reliable estimations of amount. The company estimated the repair cost to be 14,000 ringgit, which represent the expected cost of fulfilling the warranty obligations. Therefore, all 3 conditions are satisfied and the company should recognize a provisions. Next is the measurements of provisions. There are several factors that affect how the provisions amount is measured. First is best estimate. The provision should reflect the most realistic estimates of the expected cost. Second is risk and uncertainty. The estimate should consider the possible risks that may affect the obligations. Third is present value. If the payment will occur in the future, the provision should be discounted to its present value. Fourth is future event. Expected future changes that may affect the cost should also be considered. Finally, expected disposals of assets. Any gain from selling assets should not be included when estimating the provision's amount. These factors help ensure the provision's amount is measured accurately.
Today, I will be presenting on how we report and discuss financial obligations, specifically provisions and contingencies within the financial statement. It ensures transparency for all stakeholders. For instance, look at the statement of financial position. When a provision is recognized, it must be classified correctly based on its timing. If the obligation is settled within 12 months, we report it under current liabilities. If it's longer than 12 months, we record it and it goes under non-current liabilities. Why do we do this? It's simple. It helps investors understand the company's liquidity and see exactly when the cash might flow out of the business. Next, we move to the notes to the financial statements. The numbers on the balance sheet don't tell the whole story, so the notes provide the details. We must include a reconciliation table showing the movement of the provision from the start to the end of the year. But more importantly, we must describe the nature of the obligation. We explain the uncertainties like when exactly the payment might happen or how we calculated the amount. If we have a contingent liability, which is a potential debt that isn't certain yet, we don't put it on the balance sheet. We describe it here in the notes so it doesn't catch anyone by surprise.
To wrap things up, I provide a question. So the scenario is like this. Imagine our company is facing a lawsuit. Our lawyers say it is probable we will lose, and we can reliably estimate that it will cost us $1 million. Should we record this as a provision on the balance sheet or just mention it as a contingent liability in the notes? The answer is we must record it as a provision. According to accounting standards, since the loss is probable and the amount can be estimated, it must be recognized as a formal liability. We only use contingent liability disclosure if the loss is just possible but not probable.